I have some intentions to deliver to you guys today, and I don't know, I may as well introduce myself a little bit further. I'm a 26-year veteran in the lending business. I live in Queen Anne. I've lived in Seattle my entire life. I've got two kids, one who's a high school senior and a 12-year-old sixth grader. So I'm a cheer dad, I'm a lacrosse dad, I'm married, like to go boating, love water skiing. A little bit about me. Always fun to know a little bit about your speaker. But my intention today is to help the attendees here understand what's going to be happening with interest rates, how to do some forecasting of that. I want you to have a comfort level of where the values of properties will be heading in great likelihood. And then I want to share with you a scenario of a possible outcome with some nice conservative numbers. So if I do that, guys, successfully, and I keep you somewhat entertained, would you be open to giving me a review on Google for my speaking abilities?
Certainly.
If that's okay, if you get on the phone, can't talk, give me a thumbs up for that, and that'd be awesome. Cool. All right, so we do have kind of an intimate setting, so if you want to join in or if you have a question, it's hard for me to see faces because nobody's got their camera on, but if you want to share, I'd love to. It helps me understand if I'm putting you to sleep, if I need to speed up or slow down. So I invite you to participate if you would like. So let me get my screen set up. All right, guys, can you all see my screen?
Yes.
We good?
Yes.
GB?
Yes.
Good, okay. All right. So a little counterintuitive, right? How can higher interest rates help you as a buyer? Who is this guy? What is he talking about? This is crazy. Well, let's get into that a little bit. So I want to share with you what the main driver of interest rate team is inflation. And as inflation goes down, so do mortgage rates. And you can see we apexed on inflation in September of 22, and it's been coming down ever since. The Fed is working hard at slowing down the economy and inflation, and it's working. Okay. And this is not magic, but it's a forecasting tool. And I want you guys to be aware of this. So what you're looking at right now are the numbers for CPI or core CPI. And we're going to use core CPI today, and it's a measurement of inflation. Okay. So if we take 12 months, so if we take 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 months of these numbers and combine them together, there's a little rounding and compounding. But if we round and compound them together, what we're going to have is inflation, right? So every month, new numbers come out. And you can see that March was a pretty low number in 22, right? And that number for 23 comes out in April. So we had this number come out, and it didn't really do much because this was a fairly low number, and we replaced a low number with a low number, right? But look what happens in May. When April comes out, what are we going to do? Probably going to replace a higher number with a lower number. So now our year over year numbers do what? Do they go down or do they go up? GB, I can only see you, so down, right? But look at
Your
this.
your numbers will go down once those ones fall off.
Yay, right? So now Garrett can forecast what's going to happen with inflation in the month of May, in the month of June, because now he has an awareness of what happened in May of 22. And when the May numbers come out in June of 23, more than likely, we're going to see a lower number. And I'm going to show you why it's a great likelihood that we're going to see lower CPI numbers in the future. So shelter costs are lagging. Well, what the heck does that mean? Well, I'm going to try to do my best to explain it. But what's really also important is that this shelter cost number is 43% of core CPI. So I happen to know that Garrett owns a house and his mortgage payment is blah, blah, blah. But that's not what a shelter cost is. That's not part of the shelter cost. What is what a renter would pay for Garrett's house or the current rents for another house equivalent to Garrett's or Grace's or Dave's or whomever. So if that's what shelter cost is, and it lags behind the actual costs of shelter have come down substantially. Hold on, I gotta admit somebody that's a little late. So the costs of shelter have come down substantially, but what happened? And let's just say I signed a lease 8 months ago. Can I just immediately get the new rate that's lower? No, I can't. It takes me maybe a year, maybe 18 months. So all of our numbers back in January of 22 won't be able to take advantage of the new rates until January of 23. So it's going to catch up and eventually, but it's like a roller coaster, right? So we have at the apex of any roller coaster, you have the front of the car going down, which is real shelter costs. Hey, Bashir. And then we have the back of the roller coaster still heading up. So you can see this lag effect right here in this blue line, right? So this blue line is actually keeping inflationary pressures upward, which is bad for rates, right? And real shelter costs are down, which is good for rates because we know that it's 43% of core CPI. We can actually calculate this, guys. So here's another forecasting tool, right? The difference between 7.9 and 3 is 4.9%, right? And if we, hang on, I've got to adjust a few things on my screen here. If we take the difference and multiply that by 43%, which is what shelter cost makes up in core CPI, then we would have core CPI be 3.5% instead of 5.5%. Crazy, huh? But it's an easy-ish calculation, and it's something that's actually real. So I would assert and offer to you guys that we will see lower inflation in the months to come. Would we agree? Yeah.
Agreed.
Agreed. Cool. All right. Another thing that I want to share with you is this relationship between the 10-year treasury and mortgage rates. So as you can see here on this chart, the relationship between the 10-year treasury and 30-year fixed rate mortgages have been traditionally, and this is a 35-year history team, has been traditionally 175 to 200 basis points, which means if you take the 10-year treasury and add 1 3/4 to 2% to that, you should be right around where 30-year fixed rate mortgages would be. Now, if you look at the relationship, recently it's 300 basis points. So it's 10-year treasury plus 3%. Now, why is that? Well, the smart money is saying that, let me back up just a little bit. So you might get your mortgage from, say, Cross Country Mortgage, and you actually might pay your mortgage to Cross Country, but they're not the owner of the mortgage company. They're the servicer of the mortgage. And over a period of time, the company makes money because they service the loan. Somebody's got to pick up the phone and answer your questions and generate your 1098s and service the loan, pay the taxes when they come due. And there's value in that. But if that loan gets sold, then there's no value anymore because you don't get a little bit of money over a longer period of time. So the servicing value of these mortgages it's been sucked out of the mortgage because the smart money is looking at the market and saying, these loans aren't going to be on the books at 7% for more than a few months. They won't be on there for years, they'll be on there for months. So the servicing value has diminished as well. So as we see inflation decrease and we see rates go down, then the servicing values will be put back into the marketplace, and the traditional spread of 175 basis points to 200 basis points, or 1 3/4 to 2%, is going to be put back into the market. So we're going to see a compounding effect of rates getting lower. Okay. So I wanted to give you, go ahead.
Oh, and Jeff, I mean, that just means that then the rates are likely getting sold to Fannie or Freddie, or they're assuming people are going to refinance out, of the loan that they're in. And so that's why there's such that big spread.
Yeah. Because there's no servicing value. Usually
Right.
the servicing value is over a period of years, not months.
Yeah.
Okay. All right.
And it doesn't look like there's a 300 spread at any other point from 91 till now, just from
It's a
looking at that chart.
35-year relationship
Yeah.
up until right now.
Yeah.
Okay. All right. So I want to talk about inventory a bit and add in household formations as well as a conversation. So you see here on our chart, we have inventory or household completions and in the yellow, and then household formations in blue. So right now we have, if you look back, has anybody, I can't see anybody's, give me a thumbs up if you're not on screen. If you are hearing in the news that there's a big bubble happening and the market's going to crash, or if you have a fear about that, then let me know. Okay. All right. This team is where the bubble was right here. Okay. And you'll see household formations were distinctly lower than the completions of homes, right? It's massive, huge difference. Look at what's happening right now, what was happening last year, and what's probably going to happen as we move through the year. We have more household formations than we have houses, right? So we have this inventory problem as well as a supply or a demand problem. We have more households being created. So a household being created would be a child leaves the house and still the same family, but they go form a new household, or a couple gets divorced and now there's 2 households. So those are household formations. And I saw a hand raised, but
Sorry, Jeff, that was me, Grace. You answered the question, or you took the question right out of my thoughts. I was just going to ask what household.
what is a household formation? Was that the question?
Yes. So,
Okay,
yeah. Thank
cool.
you so
All
much.
right. Thank you for the question.
Sure.
So, team, this is hardly a bubble situation based off of purely the household formations and the number of homes being completed. Now, let's take a look at inventory. 2007, we had 4 million homes, so that's where we had our bubble, right? And where the bubble was bursting. We had 4 million homes available on the marketplace. Right now, we have 980,000. Hardly, I mean, it's really we have a supply issue for housing, right? So the real story is also not only in the 980,000 homes that we have available, but about 40% of those are off the market because they're in contract. They haven't closed yet. So now we have 402,000 that you can't shop for because they're already in contract, which leaves us with actual inventory of 578,000. And that with our household creations can be quite a bit of an issue. It does not scream bubble to me. Okay. So here is this would be a representation of active of like normal quote unquote inventory levels. So somewhere in the 1.2 million. And look at what happened to our active home listings back when we were at the 3% range, right? It was a little nutty out there, right? Garrett, we had buyers that would have a tough time getting a contract, right?
Right, 10 or 12 offers on something, which is also means we have to waive inspection, waive the financing contingency. So if it appraised low, you'd still have to come with cash out of pocket,
Right.
release and earnest money to the seller right away. And then, I mean, and this is even, me personally, I mean, we bought in Kingsgate, in Kirkland, November of 2020, and everyone's like, "Oh, did you get a good deal?" No, because we had to beat out other offers, and it was 100 grand over the asking price.
It was
So
rough.
Yep, and it was doing those same things and giving the seller 50 grand earnest money on day one because we had no other way out. We were going to go through with it a month later, and regardless.
Yeah. So now let's take a look at I'll be the first to admit, I can't time bottoms of markets. I am not that talented. But I can tell when things are either heading towards the bottom or if they are after the bottom. And after things bottom out, what happens is people come out of the woodwork, the interest rates get lower, they can afford more of a home. And then what happens after the bottom is the seller's more confident. They're less likely to cooperate and do things that are beneficial for the buyer, right? Whereas before the bottom, the seller is more fearful, there's less competition, and we might be able to negotiate either a price reduction or at least have an inspection contingency or potentially negotiate some seller paid closing costs, all of these things that benefit buyers in this market. So currently with higher interest rates, this actually benefits a lot of our buyers because those who are fearful and qualified are sidelined because what do fearful people do? They either fight or they flight. And typically there's not really a fight here, but they fly to the sidelines. So those who are emotionally and financially ready for home ownership, it's a great time to consider that when rates are a little bit more elevated. Because we can all agree that when rates come down, and it looks like they will be, right? Everybody can kind of see that based off of our charts and what we've got going on in inflation and our shelter costs, that we should see lower interest rates as a result of inflation coming down, right? Okay, so let's take a look at the last market bottom cycle. That was somewhere around 2012. And at the bottom of that particular cycle, there was an 8% increase in values, even, after the bottom, even with 2.4 million in inventory, right? So let's take a look at that. So we had 2.4 million homes in inventory, which was not bubbly. This was our bubble back here. This was outside of the bubble and towards the bottom of the marketplace, and we had 2.4 million. We have, what, 980,000 again in inventory for today. So let's just, for our next slide, I want to take a very conservative approach. So I don't know if we're at the bottom, if we're past the bottom per se, if we're right before the bottom. It's hard for me to be that much of an expert. And I also don't know, it's very hard to forecast what the projected values will be after a home gets purchased. But let's just say, for example, we would see, 5% would be conservative if we, after that last bottom in 2012, if it was 8%. But let's just use 3% in our next example. So let's just say we buy a home, $500,000, and we put a mortgage on it for $400,000, and rates have been elevated by 1% from last year. So that means that we have a $250 a month increase in mortgage payment, which is about $3,100 year over year. If our opportunity is to, let's say, you can support a lowering of values by about 1 to 2%, depending if you're using Case-Shiller or one of the other indices that are out there and available. But let's just be conservative and use 2%. So we could get a 2% discount on this purchase price in the form of a price reduction or seller contribution, which can be valuable. Especially, I think when some people signed up, their concern was about the monthly payment. So if you can get seller contribution, we can use programs like a 2-1 buy down to temporarily reduce the monthly payment to make it more comfortable. So that in and of itself has a lot of value, but a different conversation altogether. So let's just say our prices go up and rates decline, right? Or as rates decline. And we see a 3% increase in value, which would be about a $15,000 increase in appreciation. We got to throw in our costs that we're going to experience, because once rates come down, we're going to want to refinance. So let's throw in $2,000 for the refinance. Let's throw in $3,000 for the extra cost of current rates today. And then that's a $5,000 hit to our scenario. So total benefit is still going to be $20,000 on a $500,000 purchase. And we can scale this up or down depending upon your purchase price range. And I think we can agree that that's a really great benefit, even, on any investment, in my humble opinion. But that's it for the designed material today. Garrett, I think you wanted to share some things, and I want to open it up to Q&A. I covered a lot. I try to keep it in English and out of mortgagees as much as possible. But sometimes the translation does get, technical. So if I can clarify, please, by all means, ask me questions.
Well, thanks, Jeff. And yeah, it was not mortgagees. I'll do the one story that was an example from both of us for Robert and Maddie this winter. And then we can kind of open up for Q&A. So younger couple, they bought a house in North Seattle. We looked, I remember, it was between Christmas and New Year's time. So house had been on the market for about a month, and 600 grand little house. We were able to get it with Jeff for 585. Seller paid 15 grand in credit. They're gonna, take that over a 2-year time, where it's a 5% interest rate this year, 6% next year, and 7% the year after, hoping that they're able to refi in that time, which explains those the 300 basis points instead of that 150 to 200 range. But the real story and why, these higher rates are better now, back to my example from a couple of years ago of waiving everything. There was a leaky oil tank in the side of this yard, and the house has sold 4 times over 10 years over the last 10 years, but not once was, I'm sure, the buyers ever able to have the 10-day home inspection period, and everything like that. So this couple was able to negotiate, since it was a hazardous amount of oil spill in the side yard, but the owners replaced it with a new gas furnace. And so those are just things that are happening now that wouldn't have been happening last year or anytime in the last 5-6 years.
How much is a new gas furnace?
It was 12 grand.
And then they also negotiated how much?
15 to start and then 12 in the middle.
So you got them 27?
27. Yep. On a
Grand.
600 grand house. So those are the kind of stuff that are happening now. But it took risk from them too, in that dip cycle of prices had been coming down. So why should they buy now versus wait and everything like that? But the sellers were good with paying it and moving on because they were a builder and a flipper type person, and they want to get to their next deal and everything like that. So
But team,
that's
I
the
want you to-
example.
That's an amazing example that
Yeah.
is happening currently.
Right. And that's a real life one that Jeff and I walked a couple through. So those are the kind of things that we're here for. But with that being said, happy to open up for Q&A now and talk back to, if anyone wants to reference Jeff's slides, I'm sure Jeff, you can hop back onto
Totally.
those and
Yeah.
everything.
I encourage it. Bashir, you gotta have a question for me. Come on. You're the only one with the camera on.
Yeah, no, good afternoon. Sorry, I was driving from work, so home now. And yeah, appreciate the time today. I was really just getting on just to, see what's going on in the market right now. I'm I have a few homes and I'm happy with the rates right now, but looking to get back into something or get back out to invest this year. So just wanted to jump on and see what folks are talking about. So I definitely appreciate the slides, and that gave me some thoughts. I wanted to understand the mortgage versus the treasury spend.
Oh, yeah.
A little more, and how that pertains to a potential investor, and how to look at that, I guess, a little bit more holistic, right?
Sure. I want to give you the tool, Bashir. You can look at the 10-year treasury on, just look it up on Google, and then add 3% to that particular rate on any given day. It's not going to be exact, and it's not going to be, but that'll give you about where rates will be. Investment properties, you got to add probably another 1.5 to 2%. So are you talking about owner occupied or non-owner?
Non-owner,
Non-owner.
right?
So a couple of things, well, on that, when it's quieter like this is where the investor comes in and buys at price. So they don't sit back and wait for the rest of the retail market to get all super happy about rates, because the investor's looking for price, because you don't make money on your rate, you make money on your buy, right?
Absolutely, yeah.
So we want to be active in looking as investors for the deal today, and then be aware of this phenomena that's going to occur with inflation coming down, with the Fed doing what they're doing, with this gap that, we've got a 1%, anomaly here in servicing values that's going to change and shift as the market mellows out. And then you refinance your investment property into something a little bit more right size and go from there.
Right, okay.
So that's what we're doing now. I don't know we can talk offline if you want about different products and how to make your life a little easier if you've got multiple properties. So
Yeah, definitely talk about more products, but that does give me perspective on just timing and guidance and how to use that, that
Totally.
tool. Yeah,
when it's
that's-
quiet, you buy. When it's noisy, you sit back.
That's right. Yeah, when nobody's buying, you buy, right? So
That's right. And
Absolutely.
the guy, I don't know, what was it, the Great Depression, it's like, I think JP Morgan said, when my shoe shine guy says to buy stocks, that's when I sell everything.
Yeah.
Right.
Anyway, Charlotte, what do you got for me? Calling you out. You gotta have a question. She's not. Okay.
I'm curious what you guys
she doesn't.
think of what is it that they're passing? It's not a law, but they want more multifamily homes on properties, and eventually they're thinking that will I'm not glut the market, but provide more housing
Yeah.
for people.
That's Garrett's. You take it away.
Yep. No, you're, yeah. So, and Charlie, I'm going to see if I can pull something up here while we're talking, but I'll send it to you. That was a lot, a lot of what they're doing is all for, for infill purchase and middle housing. So it's a lot of the, city of Seattle and city of Kirkland both can do it right now where you're building an ADU and you can condo lot line adjustment. City of Tacoma and Bashir, this is something for you to think about too. City of Tacoma, they make you keep the look of the front house, and so that one it's not as monetarily beneficial because it doesn't have then that big 2-bed 2-bath 1,000 square feet flat rooftop deck kind of thing. It's more just an oversized garage, but those are kind of stuff. But anyway, let's see. I'm going to will you let me share the screen?
Should be able to, GB.
Okay, just a second, let me pull it up. Because yeah, it's the Washington House bill that just got passed.
That's the one. I'm curious to your guys' take on that.
Yeah. I mean, my take is it's a good thing because it creates middle housing that wasn't there before.
Mhm.
Also benefits if you do own a home on a bigger lot. So here it is right here to this House Bill 1245. And this is it. Thanks. Google does a good job of it. But so pretty much you can split your lot, or add another unit on there. So I'm thinking of, Bashir, I'm thinking of knowing your place is the Mount Baker townhouse. You can't really do anything with it because it's jammed in next to other stuff. And then your hill off the back side of your Skyway place would make it difficult for access down for a road or something. But, it's great. It's great if you have an alley access. It's great if you've got, a corner lot kind of thing. But yeah, so Charlotte, I would say it's a good thing.
Totally.
Interesting. Thank you. I
Right,
appreciate that. Yeah.
Yeah. Do you have a thought on it?
No, I was just curious. I've kind of just been watching, what's going on in the markets, and we have a place, but I'm always curious in possibly buying another. And
Right.
I like your points. I'd never thought of those points for buying right now.
Right.
Grace, you have your hand up.
Great, thank you. So a couple of quick questions, please. And again, forgive my ignorance. I have zero expertise in this. I'm a pure buyer. And Garrett,
You
is
have expertise
aware-
in many other areas that we don't.
All right, well, thank you. So, been looking for a few months now, and long story short, I did, and pretty active on Zillow, and Garrett is always sending me stuff, and Zillow sent me, stuff and all that. There was a home that at some point recently I really liked, but because I had a work situation where I was potentially going to move, never move forward with it. Long story short, I noted that it sold, because Zillow gives you all these updates, and then shortly after, maybe about a month later, it's back in the market, but now as a rental. And I haven't, made any inquiries and all that, but curious to know, just based on your experience, would that be indicative of either that it's an investor, that bought it and just rented? Now, sorry, backdrop is that this is a $2 million home. So my question is this a renter? Would your first guess would be an investor that purchased it and is just trying to rent it out? Or would it be, and again, excuse my ignorance, or would it be that they bought it, found some kind of deficiency, and are trying to wiggle their way out of that? First question.
Well, it's one of two things.
Eh,
It's probably not the second one, where they
Okay.
found a deficiency and now they're trying to wiggle out. It could be the
Okay.
owner that then never got it sold. They had it up for sale, but then took it off and now are renting to try to get back to last spring's price. Maybe they had $2 million was their hope for last spring. They didn't get it, and now that interest rates are higher, they can't find a buyer. It would seem, in my mind, based off of a $2 million purchase price for a big house that's probably renting for even $5 or $6 grand, it wouldn't make sense. You wouldn't be making money even at 20, 30, 40% down payment with today's interest rates to offset that for what you could get in rent. So it could be an investor that has a short-term outlook. Because Jeff, I don't know that many $2 million single family rental homes that pencil out. It's got to be for, either for a family member that they're just waiting for, or it was the old seller trying to get their number. They're not, but maybe they'll get their number next year.
Not
Now,
unreasonable.
Garrett, oh, I'm so sorry, Jeff. Sorry. I want
Oh,
to
Go for it.
just quickly chip in that
Yeah.
Zillow actually said, but again, I'm just seeing the customer facing stuff. You guys know the insides of this. Zillow said, I saw it when it went pending, and I saw it when it said it was sold.
Okay.
So not sure if that makes any difference to what you're saying.
Yeah, then it's probably not just the owner that took it offline. I mean, probably an investor did buy it, but it wouldn't really pencil out to make, like I'm saying, it probably even at 500 grand down, 150 grand loan, or 1.5 million on the loan. Your monthly payments got to be 8 to 10 grand, and your rent's going to be 5 to 6 grand, right, Jeff?
Yeah, the rent is about five plus,
Yeah.
it sounds like a one-off and very specific to that particular buyer.
Yeah.
Got it. Okay. I'm just
Good
curious
example,
I've
because that's your competition though, right? As someone who's going to buy that, when you're going to owner occupy it, and it's like, shoot, if that's the competition, that's not good.
Yeah, I guess I'm trying to get guidance, and I've kind of moved on, even though, because by the time I got clearance about, my future, it was already sold. So I was kind of curious. So the reason I'm asking is this something would it make logical sense to approach, I don't know what they do in these kinds of cases, rent to buy, whatever, or I just wanted to be sure that it wasn't something that was going to turn out to be a lemon or something. Again, forgive my lack of experience.
Cool.
My other question, back to you, Jeff. So thank you for that. My other question is, so I want to make sure I'm understanding right, that right now, high interest rates notwithstanding, it is a buyer's market versus a seller's. Is that what I'm understanding, or did I get that totally wrong?
That's definitely a good Garrett question. But what I can,
In
What I
interest
can
rates
tell you-
notwithstanding, yes.
Okay.
with interest rates, that will sideline a lot more people, which makes it easier to buy,
Okay. Yes.
less
got it.
competition.
Mhm. Okay. That piece. Thank you. All
Yeah,
right. Thanks so
Yeah, of
much.
course.
Appreciate it.
Yeah,
Totally.
Dave, do you have anything else? And then we'll kind of, be able to wrap it up here before 6. I'll do the Wheel of Fortune raffle and go from there. But Dave, any questions for you? Dave's iPhone. Okay. Well, I just want to honor you guys' time and thank you so much for being on and for asking questions. So I've got a little wheel here, and then we'll spin it for the
Do we
Kirkland
missing
wine.
somebody?
I took Dave off of there.
Okay.
Dave, do you want to come back in? We'll put him in here. Can't hear him, but we'll add him. Okay. Alrighty.
This is
Let's
cool.
see who it is. Charlotte. Okay,
Winner, winner.
Charlotte's
chicken
the
dinner.
winner. So
Oh,
Charlotte, what I'll do, I'll connect with you offline, but it's 2 tickets to this Kirkland Wine Walk here, June 16th. You know, it's a fun thing. I'm sponsoring the wine bags, and but it's a good deal all around. So
nice. Okay, thank you.
yeah, of course. We'll just wanted to thank you for being on here, and I hope this was helpful to you guys. Jeff, I really appreciate what you've done and what you put together, and really for all of us, it's how do we help, how do we help you guys make a confident and competent decision in whatever you do. It's like,
Yep.
Yes, the interest rates are high, things are difficult, but when's the right time to buy, and how do we do it? And it's when's the right time for you, but we want you to be ready,
Yep.
and know the full scope. So
By the way, guys, did I teach you how to forecast rates? Give you insight into inventory? And then give a clear example of a benefit of what could happen by buying now?
Yes.
Yep.
Okay.
Yes, thank you.
Yes.
Awesome.
Thank
I'm gonna
you.
hit you guys up for a Google review.
All
Okay,
right,
Sir.
good.
No,
sounds
All right,
good.
Thanks, guys.
Thank
you.
you.
hey, thank
Thank
you
you
all.
both.
Appreciate it.
Bye, guys. Thanks
Thanks.
so
All right,
much.
talk
appreciate
soon.
it.
All right.
All right, take care.